Tulane University. And Oleg, you have 75 minutes to present. And everybody who's in, if you wouldn't mind putting your questions in the chat box, and I will moderate and interrupt Oleg periodically to ask him those questions. So again, thank you so much for coming. Thank you to Oleg for presenting. And Oleg, the floor is yours.
Thank you, Kevin. Thanks again for having me here. It's a pleasure to present at this very innovative seminar series. And it's a joint work with Yan Liu from Purdue and Burke Sensoy at Vanderbilt University. So as the title suggests, we are going to talk about some perils of diversifying private equity exposure. To be more specific, let me give you sort of the intuition of the paper in a nutshell. Now, a typical paper that talks about investing in private equity asks a question, what happens if you add a diversified portfolio of private equity to your overall portfolio? Does your Sharpe ratio go up or down? In our paper, the question is, what happens if you add a feasible exposure to private equity? What happens to your Sharpe ratio then? How different the conclusion is going to be relative to that typical question? Why this is a relevant question? Well, it looks like most of investors, which are called LPs in this subset of investment universe, they participate in private equity in a way that is far from what one could call a diversified exposure. Okay, now probably many of you know that many institutional investors, such as pension plans, endowments, what have you, target participation in private equity for various reasons. Usually based on what some of them report to data vendors, it's an allocation between 3 to 30%. It's useful to look at one of those typical, or let's say canonical investors in private equity, CalPERS, which is a California state pension plan with about 400 billion in assets, as an example of how one would participate in this asset class. And you would think that they do it in a more or less index-like way, right? So they take something very close to a whole market of these private investment opportunities. So on this chart, I have a number of funds that CalPERS committed each year, private equity funds, both buyout and venture capital. Now you can see that the numbers vary, but they seem to be consistently smaller over the past decade or so, especially starting 2013, than they used to be before, especially relative to that period that binge around 2006, 2008. Now you may think that they just cut down exposure to private equity altogether. That's only sort of part of the story. In fact, it's not. Yes, the total amount of money they tried to put to work in 2018 is smaller than 2008, but it's like 4 billion versus 8, okay? Not a factor of 10. So as a result, the average ticket, like how much they give to a particular fund in commitment, went up from around 100, that has been a sort of norm up to 2013, to more than 300, more like 400. Okay, again, how many AT funds? Well, it's less than a quarter. Even during that peak, it's less than a quarter of what has been raised in that year across various institutional grade private equity vehicles. So CalPERS, why they did that? Well, there is some press around this decision, but the general flavor of it is that they wanted to try to cut internal cost of running this program, and they claim that they have succeeded to, reducing the amount they spent on sort of due diligence, monitoring, and all these processes by many millions of dollars. Sort of the insiders suggest that they try to keep the amount of relationships with managers to about 30 in total. Given that they try to raise a new fund every 4 years, you get around 7 to 8 fund commitment per year. So that kind of raises the question, okay, well, is it a diversified exposure really? And the second question is, what happens in other funds? So the chart on the right, it's basically a sort of cumulative distribution function estimate, where the solid line suggests that half of the funds, actually 60%, half of the private public pension plans invest in about one fund each year, okay? And only 15% invest in more than 5, right? So clearly from this chart, we can say that CalPERS is an outlier. And it's not just a 1 year, they skip activity. If you accumulate the amount of the number of funds that committed over the period of 3 years, you still get something that is very close to what we can infer from 1 year line, and only half of them invest more than 3 funds over a 3-year interval. So that strikes as a little low, especially if we think through what this fund really looks like. So as opposed to a mutual fund that invests in a rather diversified portfolio of various stocks, some of them can be small, some of them can be big. What a private equity fund is a collection of about 20 deals, which are done in either young or very levered companies that are meant to hold anywhere between 2 and 8 years. In fact, as an investor, you don't even get to choose when the money actually goes in the fund. So what you get to decide is whether you commit to the fund or not. After this point is going to be the discretion of the general partner as to when they actually deploy the capital. For example, they can call some amount, on the day the fund closing, then they can do it, a few months later. They're supposed to give you like a few week notice, and that's it. So all you know is that they're supposed to not call more than you committed, and actually they cannot call more than you committed, and that they are supposed to stop calling it about 5 years after the fund started operations. That's investment period. Even during the investment period, they can return some of the money that they have previously called, and usually that happens because they exit investments that the fund made, and the contracts suggest that they cannot reinvest it, with some very few exceptions again during the investment period. So the money should go back to the investors, and the overall duration of the fund on average is about 6, maybe sometimes more years, and that reflects the average holding period. But the span of years that the fund is in operation can be pretty long, up to 13 years. So with that in mind, what we got to realize is that, well, it's not just you have very high aristocratic risk of returns stemming from each particular private equity fund, but you're also stuck for a decade in it. And you can technically, especially more recently, you can try to trade your stake in a private equity fund, but that happens much later, somewhere here of the fund life. And again, it's a very costly business. It takes time. It requires an explicit blessing by the general partner. So, Robin Hoods are not coming to this marketplace anytime soon. So, and that's what drives this magnitude that is much larger in private equity in comparison to, say, hedge fund investing, which has been started by Eng, Rosecroft, and Zhao in 2008. And they found that basically for that undiversification argument to bind, you have to have pretty high risk aversion of the investors, and or some sort of problem with picking good managers. As you will see, you don't need that. You don't need these conditions for this constraint to be binding in private equity. Okay. So what are the key findings that we're gonna explain you in some greater detail? It seems like a typical fund investor endures significant under diversification cost. We're talking about 2 to 8% for small portfolios, which will depend on the allocation and the fund types invest in. And it's still pretty meaningful for even the mid-sized portfolios that invest in 20 to 30 funds over a decade. Now, chasing top-performing managers, which seems to be like the mantra of why you actually participate in private equity. You don't want to invest in an average, you want to invest in a top. So chasing appears to actually be harmful for a large portion of combinations of risk tolerance and portfolio size that we have considered. And it's still consistent with some sort of anecdotal evidence, relatively more rewarding in venture capital than in buyout funds, or rather with buyout funds. Now, sort of these facts suggest that it kind of makes sense to have a secular trend towards low overall risk that a typical fund would be taking. It is consistent with a flourishing fund-of-fund industry, and also a secondary market for stakes in mature funds, because many LPs feel pressure to sort of diverse the tail end so that they can have a little bit more diversification in the front end. Okay, so these are the key findings. We're going to claim contribution mostly to the private equity literature, and again, partially because it's somewhat distinct in the type of investment vehicles that we have over here. Even though it's a growing size of the investment marketplace, and some estimates suggest that the rate of market capital growth, market capitalization growth in private equity has been double that in public equity over the past decade or so. So we definitely talk to the questions of what is the optimal intermediation and portfolio choice in private equity, and what are the sort of trade-offs about manager selection. We incorporate the risk inherent in selectivity, not just sort of the expectation of being better than average. And we also have some interesting results for this sort of question that we have started the motivation with, the performance of diversified private equity portfolios. So we sort of develop an estimator that sort of handles data that is far less high quality than typically required by this literature. And it is pretty robust to sort of all kind of tradable factors you can imagine, and so long as you are happy with time separable preferences of investors. Okay, so these are the key sort of points I want you to take away. And now let me talk a little bit about the methods. So ultimately, what we want to do, we want to estimate expected utility of investing in private equity. And the framework we have in mind is similar to that in around 2009. We are trying to actually estimate the utility of growth that is a function of some excess performance in private equity. Okay, so that's the excess return of a strategy that invests in private equity and has a horizon of tau. Okay, so the allocation is going to be a choice variable, and we won't try to estimate it. We're just going to look at various allocation that are plausible or sensible. That's going to be C here. And then what we need is a gross return of some passive benchmark, okay? Some fallback strategy that you would have done otherwise, okay? We're going to denote it with our superscript B. Important thing is that it has to be on the same horizon tau, okay? That's our sort of ideal framework, and the reason we don't just do sort of mean variance analysis is because we have very skewed and dispersed returns, as you may sort of realize at this point. And Kroll et al. Argued in 1984 that while generally mean variance approximates expected utility pretty well, but not unless you have these highly dispersed returns. Clearly, if they knew what the dispersion returns were in private equity, they would have given this example in 1984. Okay, so that's our sort of ideal setup. Let's look at the data that we have. We will work with a large sample, probably the largest sort of commercially available sample of private equity funds, vintage over the past 40 years. We're going to stop in 2012, so we don't want to deal with very young funds that are very far from resolution. Their performance numbers are really hard to interpret at this point. Now, just over 2,100 of them invest directly in buyout transactions, and 1,600 invest in venture transactions. 900 are so-called fund of funds, so they invest in portfolio of direct funds. 1,800 of them have complete cash flow history, and so we can do this standard risk adjustment procedure and obtain this excess return estimate using the instruments in the literature. However, the majority of our sample actually don't have this information. We only know what was the so-called MOIC, which is a ratio between total money out from the fund to total money in from investors to the fund, net of all fees, of course, and internal rates of returns. In fact, for most of these funds, the cash flow history will never be known to the investors. And it's a missing observation, from all studies that try to sort of ask a question of excess returns. So we will try not to make assumption that it's just missing. because we want to characterize the cross-section. We want to have as big of a variation in possible returns as possible. So therefore, we're going to try to come up with a way to handle these funds in our analysis. Now, one feature that will permit us doing that is that if you know both MOIC, which can be heard essentially as a gross return of the fund over the fund lifetime, and its return per year, using these two data pieces, you can actually impute duration. Okay, so that's an important aspect there. And then we will use at various points data on private equity fund investors, so-called limited partners, and we're going to use return series for S&P 500. Again, we don't try to innovate anything at all on as far as the public market part is concerned. Okay. So as far as what the dispersion of returns are, that's actually not a dispersion of individual fund returns. These are average MOICs by fund type and vintage year during our vintage sample. First of all, note that the amount of funds that that is raised in a particular year has been increasing, and you know, at the peak it's around 400 a year. Okay, but it was a little bit sort of not as populated, not as well populated in the past, and that's partially what explains high variation in MOICs across these years, and but also there's a bit of a trend towards less risk that these type of funds seem to be taking after 2000, and that's part of some other research I'm involved in. Here, what we can say also is that there is a variation in the average returns across fund types, right? Typically, what you gotta see is that you know, there is a buyout that they're going to be a little bit above, eventually will be below, and fund of funds will be in between. Partially that's because they invest in a portfolio of buyout and venture. Some of them specialize in a particular type, but we don't know that information in our data.
Oleg, we have a question.
Please.
It's from Sugata, who says, most ultimate investors, quote unquote, in the LP, say an employee covered by a pension plan, may have exposure to other assets, real estate, 401ks, other pensions, etc. Why are we looking at this at the LP level rather than the ultimate investor level?
Thank you. Great question. Because thanks for the Freedom of Information Act requests, we can know what happens at relatively well at the fund level, and we have performance data there. But we don't have enough sort of information to speak to that at the individual LP level. But we will make a simplifying assumption that the LPs invest in other, the rest of their portfolio, or risky part of their portfolio, in something very liquid. So whatever we find is probably a lower bound to the actual sort of problem that they face if they also invest in various real estate and similar partnerships simultaneously. Does it make sense?
Yeah, so a follow-up from Sophie Chavez, she says, relatedly, investors like CalPERS have large stock portfolios.
Yes, yes. So we will look at the fraction that they allocate, or hypothetical LP can allocate to private equity, assuming that the rest is in S&P 500. So it's a little bit oversimplifying, but it is a deliberate oversimplification. So we see sort of the first order effect, even if the rest of the portfolio is very liquid. And pretty much there you don't have these problems of you know, choosing when to invest and how much. So bear with me on that. I will elaborate a little bit when we get to the results and how we interpret them. Okay, thank you. So, so these are the average MOICs. So what are we going to do? We are going to try to figure out, okay, how we can approximate this excess return in the whole sample of our funds, not to mention individual LPs, based on some intuition that I think is quite straightforward. So the intuition is the following. So first of all, the standard way to measure excess returns in private equity, when you do have cash flow information, is to try to estimate what is known as a public market equivalent. Implicitly, what you're going to do there is you're going to run sort of an SDF method estimation where your discount factor is something that a log utility KPM would imply. Basically, you will use the gross return, the inverse of the gross return of the market index to discount the distributions and the capital calls. So that can be interpreted as a ratio of two NPVs of distributions and capital calls respectively. So money out, money in. So that gives you a sense of what was your excess return on a particular fund. So there are ways to sort of enhance this and actually calibrate the discount factor a little better to reflect the realizer's premia. We will not go that direction because it won't matter for our application. But in the end, if I have time, I can talk a little bit as to whether our estimator is actually sort of as robust as the first best in the class of PME-like estimators. But what we're going to take from that is, well, if you know MOIC and we know PME, then the ratio between the two has to say something about the return, the gross return, that is attributable to the market benchmark, right? In our case, we'll use S&P 500, right? So what has the S&P 500 has delivered in terms of gross return during the time the fund was invested. And this benchmark will have the same duration as the realized duration of the actual fund by construction. So what we're going to do then, we will say, okay, how about we actually try to sort of reverse engineer the excess return that PME will tell us by constructing PBMMs, the public benchmark money multiples, for all funds, and we don't need, in fact, cash flows for all of them. We will borrow some of the techniques how to build this mimicking funds for the cash flow subsample. We will match the closest PBMM by duration to every single fund within this particular vintage year and fund type, and we will adjust the remaining differences in durations. Okay, so this is a little bit sort of a tedious exercise, but it's very simple and hopefully intuitive. So we'll try to get a best possible estimate of this PBMM at the fund type cross vintage year, and we actually find that it seems to work very well. In at the fund level, we have an R-squared north of 90%, and what's key is that the root mean square there at the fund level, at the fund type level, and vintage is very small. So that that is a graph that gives you a sense of how close we can get for the excess return measured by PME using our approximation. So what's key here is that we hit the means pretty close. There is a bit of a variation, but the ranges are usually pretty good. Okay, so we are spanning the excess returns for the subset of the funds where we have good information pretty well. So we are hopeful that for the remainder of our sample, our approximation is good. And like I said, in reality, we will never learn what the true cash flows have been for many of these funds, because back in the days, people haven't really even recorded those cash flows properly. So I think it's important to know what the excess returns are for the larger sample of funds that doesn't have cash flow information available to scholars. Okay, so now this is the average by respective fund type and vintage year PBMM. Okay, so this is going to go directly in our estimation procedure, as you will see. And what I want to show you from this chart is that there is a bit of quite a bit of time variation in this, as well as variation across fund types. Now, what does this reflect? And again, the x-axis here is the vintage year, the inception year of the fund, and it's the same public benchmark, right? The S&P 500. There's no like variation across fund type. So all the variation has to come from two things. So across vintages is the return that this particular benchmark has sort of delivered over the subsequent 10 years, even though the duration won't be equal to 10 years. It will be specific to the particular vintage fund type duration. And it will also reflect the variation in that duration. And the variation in the duration is what explains the variation across fund types. It's important to keep this in mind because we want to make sure what we compare in terms of expected utility is apple to apple. Okay, so almost done with methods, but let me again sort of go back to that sort of idea of expected utility approximation. So we're going to construct this curve as of the end of the fund duration. Okay, this W conditional on the particular strategy, is going to have a duration of tau, and it's going to be a function of some initial growth. We will, for the most part, normalize it to 1. We're going to have this return on the public benchmark money multiple, public benchmark strategy, and then we're going to have the excess return on the fund. Now note that the return on the benchmark is vintage-wide, whereas the return on the fund is fund-specific or strategy-specific. And the intuition here is that there should be no additional utility coming from the fact that there is some variation in the fund duration if you invest in public benchmark, because there you can control duration. Okay, so that's something that we want to be very clear about. So whatever we are finding is not because we think that there is some lack of control or uncertainty about the duration of the public benchmark strategy. No, it doesn't drive our result. Okay, and yeah, as in that sort of bird's view slide I showed you before, C is the amount of or fraction of your portfolio or risky portfolio, if you wish, that you will allocate to that particular P strategy. Okay, so then we're going to take this W, a function of how much you allocate and what is your initial wealth, and then what is the reasonable range of risk aversion. And we're going to estimate basically using bootstrap, where these are going to be empirical probabilities of investing in a particular fund, in a particular vintage. What would be the estimator of expected utility, okay, from a given strategy and all other inputs that we can list and justify a range of. Then, as I told you, look, there is some variation in PBMM across funds. So for us to be able to compare it meaningfully, we need to actually scale that utility by something that you can sort of obtain by investing in a public benchmark in a similar way. So therefore, we propose this public market certainty equivalent measure, which is going to be simply a ratio of two certainty equivalents. One certainty equivalent, the numerator one, invests C, which 20, 10, 30% in private equity strategy, whereas the denominator certainty equivalent invests 0 in private equity. So everything in all the variation in the denominator certainty equivalent is coming from the public benchmark. Okay, so that's it. So let's take a look at the results. Any questions at this point? That's a good point to ask those. No? Okay, hopefully everything is clear. So then let's talk about the results. So we'll start with a relative extreme case in which private equity represents 100% of your allocation to risky assets. This is arguably not what they normally do, even though there's this famous case about Boston University suggesting that they did something very similar indeed. But it is important to sort of build intuition as to what is it that we are doing and how to interpret the figures that I'll be showing you for the remainder of the presentation. So again, here our numerator, sort of certainty equivalent, has a 100% allocation to private equity. And if you were risk neutral, you can interpret the certainty equivalent as essentially average, right? So there's no correlation in utility function. This is basically a vintage-weighted average money multiple or MOIC from average fund. Now, if you invest in the whole vintage, it's not going to be different than if you invest in a random fund from the vintage, so long as your bootstrap sample is large enough. And that's what we can see here, right? So it doesn't affect the mean multiple. However, if you first take sort of evaluate your utility from each realization, and then you're going to see some discrepancy between investing in an average fund, investing in a random fund, because the tails of the strategy that invest in a random fund are going to be much thicker. So here we can see that the certain equivalent of investing 100% of your portfolio in a random buyout fund is only 1.07, 7 as opposed to 2.09. Okay, so it's a significant loss in utility because of that tails, right? You don't like that left tail especially, and therefore you have this discount. Now, what about PBMM? First, note that it also drops, right? You have a decrease in certain equivalent if you go from being risk neutral to having some correlation utility function. The drop is more moderate as it is here, for example, but not by much, right? So here we have a drop of about 8-ish points. Here the drop is around 7.07. So as a result, you can sort of think that the variation in average MOIC for buyout funds is not that sort of different from the utility standpoint than that of public benchmark strategy. And as a result, you can still argue that if you take the ratio between the two, it would suggest that investing in private equity is a great idea. Okay, so if you can take this diversified exposure and, in a sense, basically invest in every single fund in the vintage, in this case, we're going to assume it's equally weighted, you would be feeling really happy. But again, keep in mind that this approach assumes that S&P 500 returns basically fully explain your preferences. That might not necessarily be true for many investors. For example, you may have some sort of problems with liquidity management. It's completely outside the scope of what we want to do for now. All we want to do is focus on this sort of first order effect, is that if you go from average to random, your PMCE drops from 123, which is above 1, which is good, to only 0.63, even if you have low utility preferences. Now, this gap widens further for investors with, say, a gamma 5. You would very much not want to invest in private equity if you're picking one random fund, but you would like to do that, and you would like to be invested even more so than in case of lower risk aversion, if you could pick up exposure to the whole vintage year. Okay, so that's kind of like the intuition as to what we're going to be sort of doing. I'll be showing you these PMCs for realistic allocations and various parameters of risk aversion. Now, why we're not estimating a particular parameter risk aversion? We don't know what it is. I'm sure few investors have any idea what it is for them. It can vary over time, but we can put some reasonable range on it. Okay, and we can say, well, what if it is 2? What if it is 5? Then same thing with allocation. In private equity, the notion of how much you allocate is actually somewhat nebulous, because again, you don't have a control over the cash flow schedule. Your effective allocation can vary. Now, funds report you some net asset values, but they are managed and they are subject to a pretty heavy appraisal bias. So you don't really know or have a direct control over the allocation to private equity, but you can have a range again about what is possible given how much you put down in each fund in commitments each year. Okay, so that's the plan going forward. All right. These are the numbers I showed you were for buyout funds. What about venture funds? Well, as you can guess, it is pretty bad, right, in terms of a pick and random fund versus average fund. But surprisingly enough, in venture, if you invest again everything in your in one single venture fund, somehow because of that right skewness that you do have in venture relative to buyout funds, these results don't seem to be as costly as lack of diversification buyout. But this intuition that the buyout is somewhat less, sort of more dangerous than venture, won't hold for realistic allocations. But just want to make sure that it's clear why it is the case, because in general, here the skewness effect tends to dominate a little bit, and the drop in PMCE relative to an average case is not as severe here. All right, let's talk about realistic allocations. 30% is, few of them target 30%, but many of them can have eventually 30%, again, because they don't have a good idea of how much is invested in private equity at any given point of time. So what I have on the x-axis is the risk aversion coefficient. So 0 means it's risk neutral, so it doesn't really matter whether it's random or an average. Okay, you know, 8 is probably the upper bound of what's plausible. Again, we're talking about CRA utility here, because we don't sort of have a way to sort of measure temporal variation of utility that investors can do during the fund life, because we don't have data for that. Now, y-axis plots this PMCE, which is a public market certainty equivalent, and a ratio of two certainty equivalents. You can see that for 30% allocation, you still see that PMCE is upward sloping in the risk aversion coefficient if you invest in buyout for an average fund. Now, if you only invest in one random fund each year, which is half of what public pension plans seem to do anyway, it's no longer upward sloping. Okay, it's downward sloping. Furthermore, you can see that it's barely above 1, especially if you are very risk averse. Nonetheless, it seems like you know, if again this is all you care is like whether it beats S&P or not, and what the S&P return has been, then buyout seems like a good proposition. Note that maybe 15% could be a better idea, right? So on the left chart, I do exactly the same thing I did on the right chart and just showed you, except that the allocation now is 15%. So the overall level for one random buyout fund is a bit higher. It's not necessarily sort of downward sloping. And if you can do a little bit more than that, for example, 3 random funds each year, then you are not significantly worse off than if you invest in an average fund. So from this perspective, we can argue that probably CalPERS hasn't been sort of doing something too crazy. At least that's what these results suggest. Okay, well, what about venture? Okay, first of all, venture, the level is going to be lower. And it's going to turn downward sloping almost right away, and it will remain so, meaning like even if you have 5 funds, I don't show it here, but with 3 funds for very risk-averse investors, you are unlikely to be happy if S&P is all you care about. Okay, so this is what 30% allocation suggests in venture capital, and it's a little better with a 50% allocation. Nonetheless, from this perspective, buyout looks better, and the diversification in the buyout space, if you can do 3 funds a year, gives you firmly above 1. This is less so for venture capital case, right? For very risk-averse investors, 50% allocation to venture might not be a good idea. Again, if you pick and fund randomly. So I told you that, we were picking funds randomly, but the typical motto of venture investing is that we are not picking funds randomly, we are picking best funds, okay? I don't know how that can happen if everyone does it, but in principle, suppose there are some LPs that can foresee the end-of-life performance rank of the current fund manager before the manager raises a new fund. That's actually hard to do because typically it's, the current fund is yet to be resolved. And there's actually persistence in manager rank across funds if you can sort of foresee the eventual return of the previous fund. So let's suppose someone can. Okay, maybe they do some better job in analyzing their portfolio holdings, what have you. So if that were the case, and these investors were sort of skewing the probability of picking these sort of top-notch buyout venture fund managers, then if they were very sort of risk neutral, this strategy would have resulted in much better sort of returns, right? So we would have a significant bump to that PMCE, and even if you were sort of pretty much very risk averse, it would still be a good idea. However, that's what you can see from this dashed line being above the solid line. However, look at this dotted line, okay, with squares. In this dotted line, we construct a strategy that has exactly the same expected MOIC in a vintage, but the cross-sectional dispersion within the vintage is half of that, variance-wise, is half of that from the full sample. Okay, so we just do this sort of mean preserving spread in the distribution of MOICs. And so one way to think about this is, what if you actually could deliver the vintage average return, but with variance that would be much smaller than sort of the realized one. And this the reduction is consistent with some of the recent work on what fraction can be explained by skill. So if you could filter the skill really well, then you potentially could have reduced uncertainty about manager performance as a result. So you can see that these two lines cross. So there is a point around risk aversion of 3 where you would rather be able to reduce the uncertainty about the risk of the manager choice than be able to pick these top performing managers, even if you had some hindsight. Okay, so in that sense, this is a trade-off between selectivity as far as the first moment and the second moment. And you can see that this gap between these two lines, the dotted, the dashed line and the solid line, actually shrinks. So, which means that investors have to trade off some uncertainty if they want to chase top-performing managers. And in fact, that dotted line interaction suggests that there's a point where you don't want to chase top performance because they have high risk of future fund MOIC realization. What about 50% allocation? Yes, there is also a crossing point, but this is venture, right? This crazy, you know, this super high skewed. What about buyouts? Actually, it turns out this sort of crossing point for the buyout strategies is much further to the left, meaning that even less risk-averse investors would rather prefer picking a fund with less uncertainty in terms of their realized MOIC, provided that it's very close to the vintage average, as opposed to chasing the top performance. Okay, so same idea. Solid line is that sort of baseline I showed you before. The dashed one is if you have a foresight about the future fund rank, or rather the current fund rank, and the dotted line with the squares is what if you could do the shrink the uncertainty about which fund you pick by half while keeping the expected level of MOIC the same. And even if it's a 50% allocation, still this trade-off is in a region of risk aversion that is empirically plausible, right? So that can potentially explain that why we have this growth in fund size and somewhat reduction in overall risk they've been taking. Okay. Now, if you do 3 random funds, not much changes, even though you would think that this lack of diversification is much less acute. For risk aversion levels of around 4, and investors in buyout would rather reduce risk of a manager picking than pursue very selective strategies that sacrifice diversification, because these managers tend to have high uncertainty about their future MOIC realization. Okay, now towards the end of the talk, I want to mention a little bit of that fund of fund versus direct fund performance. And so the figure here is going to be showing slightly different x-axis. Now, as opposed to plotting risk aversion, I'm going to plot number of funds that you pick each year. Okay, and on the y-axis, I still have PMCE. So what you can see is that investing in direct funds, and here is going to be a mix of buyout and venture capital, and it's not very sensitive to whether you sort of weight it in a particular way or not. You can see that investing in direct funds seem to dominate investing in a fund of fund, especially if we look at that sample where fund of funds were relatively abundant, so we can do some meaningful bootstrapping here. That's kind of consistent with the findings in the literature that suggests that unless it's sort of some kind of selection story that similarly that kind of visible in venture fund funds, then buyout focused fund funds don't seem to justify the fees they charge on top of what direct fund charges. So here, this is consistent with that. But now, let me overlay two more lines here. Okay, so remember these lines. Now, let me overlay these two more lines, which show you the PMCE for the investor with a risk aversion of 5. Okay, so for the fund of funds, it's going to be this solid line over here. First of all, note there is an upward shift. Okay, relative to that case where gamma equals equal to, which kind of suggests that there's some diversification benefit actually that you gain from investing in fund of funds if the rest of your portfolio is S&P 500. Moreover, now the dotted line or dashed line is below that dark solid line, and it suggests that if you're able to pick on fewer than 3 funds, then you're better off by investing in fund of funds if your risk aversion is closer to 5 rather than to 2. So that's the sort of what we argue as perhaps the sort of most evident value from intermediation by fund of funds that also invest in buyout strategies. Same intuition with 15% allocation, even though here the crossing happens. It does happen, but the difference is not very significant statistically. But again, weekly, the same intuition holds, but with a small allocation, a strategy that invests in 3 funds appear to be still significantly better than a fund-of-fund strategy. Okay, so I think I have over budgeted time for questions, so please do shoot the questions at me. I cannot believe it's very, very clear as much as I would like it to be. But waiting for questions, let me go over some extensions that are potentially on our list and possibly part of different projects. So yes, obviously, when we're talking about private equity, illiquidity is the first argument people have. Now, it's easy, conceptually, it's easy to account for that. All you need to do is that you need to subtract the realized liquidity premium from growth. Or cumulative, you can also increase the public benchmark multiple, by the liquidity premium amount, or possibly any other exposures that you think are sort of relevant when it comes to investing in private equity. In our context, we think it's a secondary order thing because, in a sense, we are after the difference between average versus random. And if you think that S&P doesn't explain it very well, then so long as the liquidity variation or risk premium variation is also there within the vintage of buyout venture funds, then our results will be at least as strong once the liquidity premium is accounted for. So we just want to keep it a little bit sort of easier to grasp and don't deviate into that zoo of factor exposures. But we'll see what they tell us to do. There could be time variant supply of funds. There could be probabilities of picking or essentially bootstrap probabilities in our context can be made time varying and a function of some observables. Similarly, we can have allocation to private equity to be a function of certain observables, and this is very easy to implement. Again, we don't seek to estimate this optimal allocation. You can just look at the range of Gredil values that are reasonable for this CNOT, for example, and the coefficient actually can be something that one may want to estimate. And the other aspect that is the frontier of our current sort of push within that paper is how you account for cross-vintage correlations. And what I mean by that is, you don't invest just one fund, right? We saw that they invest in several funds, sometimes every other vintage, but there is some overlap between vintage life. And let me actually make it potentially a more clear point by looking at this addendum figure, which plots the overlap in distribution pattern across funds that are vintaged in different years. Okay, this is something that has yet made its way to to make its way to the draft. So maybe it's a good idea to spend a little bit more time on that. So what you can see, consistent with some previous research, there is quite a bit of overlap in terms of how much the cash flow pattern in fund, say, vintage 2008, correlates with the funds that are vintage in 2009. Okay, so it's like a tune of 80%. But it does drop if you go, say, to 5 funds. Nonetheless, it remains pretty substantial. But that's the left panel. But the right panel plots you what happens if you go to some realistic amounts that we observe empirically with our LP sample, and note that this figure, in this figure, y-axis only goes to 0.5 as opposed to 1, right? So it's right kind of like here. And you can see that for one random fund, this overlap is pretty much negligible, okay? So it's as big as it is for a diversified strategy where the fund sort of distance and vintages is over 10 years or so. So long story short, there isn't much of an overlap in the cash flow schedule. Therefore, there's no like implicit hedge of your utility that comes from the fact that you have also invested in few years consistently. Nonetheless, there is some effect. So there are 2 ways to adjust for that. One is to use some kind of a haircut to the number of funds needed over a course of, say, 10 years to have an equivalent of expected utility of investing in 3 funds each year, right? So it's not going to be like 30 funds, or maybe there is something like 20 or 25. Another way is to make a W naught, the starting rule, a function of sort of clean conceptually, but probably we'll try to do it both ways and see what we get, whether the implication is going to be any different. So with that, I'm going to close the official part, quote unquote. I want to emphasize that it seems like practitioners and economists have been overlooking implications from manager selection risks in private equity. And those are economically and statistically substantial. And that's what our paper is about. And we propose a simple and robust method to evaluate various strategies of participation in private equity. And surprisingly, it actually works very well in small samples. So that might be something I will spend the remainder of my time allotted today. It is amenable for various levels of data quality, right? You don't have to have cash flows of these fund vehicles to be able to apply them. But we do have to limit it to time-separable preferences and tradable risk factors, which is still a substantial fraction of what people have tried doing in this asset class. I would also argue that this toolbox is a way to evaluate the performance of in-house private equity team and fund of funds programs. In some sense, the fund of fund, PMC, is what the in-house utility team, private equity team needs to beat in terms of certainty equivalent. Hopefully that will pick up some traction with the practitioners. And with that, I have a few appendix slides to go over, unless there are questions and comments, please.
Oleg, we have a question. The question is from Sophie Shive, who says, do 0 or close to 0 PMEs affect your results?
Excellent question. We don't let them to be around 0. So it has to be at least 0.1, as far as I recall. This is something that we try to be careful, and we tried several cuts and doesn't seem to matter that much. But yeah, you can have a PME or actually money multiple close to 0 in this thing. So that speaks about the risk to some extent. So we don't want to over visualize here. Okay. But that's a very good question. Thank you.
Any other questions? Okay, what I'm going to do, Oleg, is I'm going to go ahead and stop the recording, and I'm going to keep the room open so that if there's any other discussion that anybody wants to have, we can do so.